Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we have arrived at what is perhaps one of the biggest turning points for the markets, certainly this year and maybe the next several. There are echoes here of that fateful June FOMC announcement in 2021, where the Fed finally said, look, we don't think this inflation is as transitory as we thought. We're going to need to prepare for a significant rate hike cycle. And of course, this is perhaps the moment where we get the next big steer on that entire story that has subsequently unraveled. We are looking at the first opportunity for the Fed to opine in the next day here with this policy announcement on how that has been going, how the fight against inflation has progressed in the wake of the failure of Silicon Valley Bank, SVB, the takeover of Credit Suisse by its rival UBS amid all manner of banking crisis and liquidity concerns, all of which, of course, come from the effort launched by the Fed to tighten credit conditions and the implications of that tightening of credit conditions reverberating across markets, institutions, banks, and participants in the financial system writ large. So all of that turmoil, for the most part, occurred at a time when the Fed was in its blackout period before a policy announcement last week. And so we've not really heard them opine directly. We are also coming into this situation with a critical question because, of course, the markets have reacted to that turmoil by substantially tossing around Fed policy expectations. So what we're going to do here is we're going to unpack what it is that the Fed faces, how they might reconcile, on the one hand, signs of deepening stress in credit markets, or at least an episode of significant stress in credit markets, with the need to fight inflation, something that we've been watching them do for now the better part of 2 years, and how tomorrow's policy announcement might then influence markets in its attempt to balance those objectives. So let's first take a look here at what the moving parts are, how we are set up, and then look at what may come next. Let's first review how we got here. You can see from the beginning of February of this year, there has been a significant heating up of the U.S. economy. So you can see that not only is the U.S. economy doing better, it is doing better than expected, which is actually more impactful than the economy actually improving. Because what it does in overshooting baseline expectations and overshooting them, as you can see here, at a graduating clip, is to essentially say markets are not featured for this. The price across asset classes doesn't reflect what is occurring here in the real economy. The real economy is better than analysts' models are projecting. So there needs to be a readjustment in the markets. What that has done is it has fueled a pickup in inflation expectations, essentially saying to the Fed in as clear a way as possible, you have not done enough on rate hikes. Inflation has come in. You can see here in the yellow is the 2-year break-even rate, which is the inflation expectation that's baked into the bond market for a 2-year window. So right inside the Fed's policy outlook scope here, you see that that's been running about 2 months ahead of what we see in the benchmark inflation measures, US PCE, US CPI. So you can see here the February bar at 3.2 and this month's bar, now back up to 2.7, are significantly higher than the 2% target that the Fed wants to get to, and that and much closer to 3% on average. So a good ways away. And so what this is saying is, in the face of this acceleration in the economy, the Fed needs to do more on rate hikes to keep the trend lower in inflation that was going on from about the middle of last year firmly intact. We can see very clearly what that pickup in rate hike expectations to deal with that additional inflation has wrought. So you can see here from the start of February, again, as you get that pickup in economic activity, so too the outlook on Fed rate hikes becomes steeper. You can see the orange line there, which is a one-year forward view of the Fed funds rate as implied in futures markets. You can see that go higher. You can also see the market starts to get a little bit worried about that, because the financial stress index from the Office of Financial Research, that's a U.S. government entity, you can see that indicator stops falling. It had been correcting lower as Fed rate hike odds stabilized in the fourth quarter of last year. As they started to move higher, a degree of concern re-entered the landscape. And of course, you can see most recently the failure of the banks that we've seen in the U.S., the stressing of the banks that we've seen in Switzerland and in Europe, the Eurozone most potently. We've, of course, seen the biggest issues with Credit Suisse, but that's had knock-on effects on Deutsche Bank and the like. So what we're seeing here then is a surging of that credit stress indicator, that financial stress indicator, and a parallel collapse in Fed rate hike odds. Most recently, here's in a nutshell then the market outcome. We can see that there's the collapse for Fed rate hike odds for the mid-year meetings of May and June, which is roughly where rates are now expected to peak. We'll take a look at that in just a second. You can see that with that decline, we of course also had a decline in the S&P 500. That's the yellow bars on the bottom there, and the dashed line there is just a 5-day average to give you a sense of where we are near term. So you can see that as rate hike odds were building from February onward, risk appetite didn't like it. Then, as we hit a landmine with SVB, those rate hike odds collapsed, stocks kept moving lower. So the relationship there between rate hike odds and the overall sense of sentiment changed a bit. And now, as those rate hike odds stabilize, risk seems to have stabilized as well. You can see the S&P 500 finding a bit of a floor and edging back up a bit as the collapse in Fed rate hike odds appears to get anchored. This is the stage setting. This is where we enter this policy announcement. If we look at how the yield curve has actually evolved through this story, it is not meaningfully different ultimately than it was with the last FOMC announcement at the start of February. And this is really the key here, that the February FOMC and the March FOMC are really far apart. The February one was on the 1st. The March one is obviously tomorrow. So in that intervening period, we had all of the February run-up in economic data, which, by the way, continues. That gave us, at one point, a shift out in the yield curve to give us a peak Fed funds rate somewhere in the 5.5 to 5.75 range. even some conversation about a 6% Fed funds rate. And then the banking crisis has collapsed us right back in. And so when you actually look at the current yield curve, which is there in the solid green, you can see the peak in rates now seen about mid-year, which is very close to where we were with the February FOMC. And the peak is at about the same area. So essentially 5%. We do see a bit of a sooner move to cut. So by 6 months out, as of February, we thought we were going to linger at the 5 for about a quarter. Now it looks like we're going to see the start of cuts already entering the picture by the time we get to September. So you can see there's already a move lower by 25 basis points from 5 to 4 3/4. We then very quickly shed another 50 basis points over the next 6 months to end up at about 4 1/4 a year out. And in another year's time, we shave off another 100 basis points. So what we are currently looking at is a tad more aggressive on where the rate cuts would start. We're looking at a slightly steeper way forward here near term, and a slightly higher ending to where rates land, north of 3% ultimately over a 3-year window rather than under. But the overall structure of the curve through all of this hasn't changed dramatically, even though in the intervening period, there's been a lot of moving around. And so what the Fed essentially must now do is to attempt, speaking relative to its own positioning from the beginning of February, and given this opportunity, this first opportunity to speak directly to what has occurred with the banking crisis, to try to reconcile, on the one hand, a warming economy that seems to beckon higher rates, and looking at those break-even rates we just looked at, seems to say the Fed has not done enough. And secondly, to do that in a way that doesn't spark concerns about further bank failures or some such instability. And it seems like the net of those two forces has landed us about where we were at the beginning of last month. The upshot seems to be that there is an 80% chance of a rate hike now baked into the market. So you can see in that percent hike cut column, we're looking at 79.6. So basically, at the next column, implied rate delta, you can see 20 basis points of a 25 basis point hike already priced into the market. Now, the Fed told us back in December they were going into fine-tuning mode, and that what we are going to be looking at then is going to be a pace of rate hikes not at the 75 or 50 clip that we saw last year, 75, of course, mostly, but at a 25 basis point clip more often. And that if the Fed needed to step back up, it would, but that we were in a kind of fine-tuning period on rates, and so smaller increment moves made sense. So the Fed can probably get away with a 25 basis point hike here, in so much as it is already in the price for the most part, and the markets are not visibly collapsing. The larger question is going to be the path therefrom. And as we just said, the markets are very much flirting with the idea that we're going to get a hike, we're going to stick with that hike through about mid-year, and from there, we are starting to tilt the other way. So if we look at what is baked into the market currently, you can see that by May, we're looking at one hike, So looking at that number of hikes slash cuts column relative to us currently, we see 1.44. So one hike is there. That's ostensibly the one we're going to get tomorrow. And a less than even odds of a second, of a further. So 44% chance of another hike thereafter. And things begin to devolve from there. So a meager 20% chance, 23% chance of a second hike once you get to June, and from July, all the numbers have a negative sign in front of them in the percent hike cut column. That's starting to tell you we're looking at a cut that's looking increasingly likely moving down. So by the time you get to September, the hike that we have baked in now is gone. And by the time you get to December, there's an 82% chance of a cut as relative to current levels. So rates lower than they are right now. And then come January, that cut is fully baked in with a 38% chance of a further cut. So there's a very quick downslope here in rates. Meanwhile, again, the economy is accelerating and saying, actually, you're not on track to hit 2%, and what you're doing is under-tightening, not over-tightening. So the current market setup then presents an asymmetric view. The Fed, on the one hand, has a market that's clearly very concerned about financial stability risk, which probably is how you have this very rapid escalation of a dovish policy pivot in expectations currently. But on the other hand, you have an economy that's very clearly telling you things are heating up, and the break-even rate is signaling they're heating up to such an extent that you've not done enough, that there needs to be more tightening. And so for the Fed, then, the tricky thing to land will be to see how can the Fed message to the markets that the inflation fight continues and that inflation expectations will be anchored and inflation will continue to be pushed lower by steady rate hikes, while at the same time suggesting that the bank's situation will be managed as an independent policy track. And to do so credibly enough that there is an adjustment that occurs that's orderly to these expectations without too much market stress, without pandemonium, without a panic. If the Fed succeeds in doing this, that's the asymmetry in the setup that gets unraveled. Rate hike expectations, to some extent, rebuild. This should be positive for yields. This should be negative for bonds. It should be positive for the dollar. It seems like it would be negative for gold. The implications for stocks become the most interestingly muddled of the bunch, because, of course, on the one hand, if the Fed were too dovish, the markets would think something is really wrong and perhaps get scared. That would be a risk-off stocks negative outcome. But if the Fed were to appear oblivious to the market's woes and press on with too aggressive of an inflation fight, that would be seen as stocks negative. And so walking the fine line for equities performance will be absolutely key. Now, the Fed will have a variety of levers that it can use to achieve the messaging that it wants. As we can see here, again, one hike is all the way baked in. And that hike ostensibly is relatively safe to do. We have the experience of the ECB just last week having essentially pre-announced 50 basis points in February for the March meeting, delivering on that 50 basis points, which the markets were not expecting. They were looking for a step down to 25 amid the banking crisis. But the ECB staring them down, doing the 50 that they said they would do, and nailing the messaging on saying monetary policy for the economy as a whole and targeted policy for the banks can occur simultaneously and independently. This is what the Fed will have to do if it hopes to stick this landing. And so, ostensibly, markets that don't want to be destabilized, that don't want to be spooked, that want the Fed to be successful, they would look relatively favorably onto a 25 basis point rate hike, most likely, that is already for the most part baked in. The key will then come from how this evolves. And of course, the comments that Fed Chair Powell makes at the press conference following the policy announcement. But this set of projections, the last time this was updated was back in December, as we alluded to earlier, this is going to be a key lever to move this conversation forward. Note in particular at the very bottom, the Fed funds rate projection for 2023, in other words, the peak, is 5.1. You can see that it heads lower from there. Hearing the Fed speak before the SVB crisis, which is the last time we've really heard them opine, at the congressional testimony that Jay Powell did just before the banks wobbled, that number is outdated on the low side, given what's going on with economic growth. So what we would want to see here is we'd want to see that number go higher, and we'd want to see the change in real GDP number at the very top for 2023 adjusted higher as well. We would probably then look at the PCE inflation number and see how that is seen evolving, both the core and the headline. So you can see now, we're looking at those coming into 3.1 at the headline for this year, 2.5 for next year, 2.1 for 2025. Critically, the break-even rate from bond markets that we just talked about is saying that objective is not on track. And so we're going to look at the makeup here of these forecasts and see, is the Fed then telegraphing in the projections the degree of how much more hawkishness it thinks the market can stomach without coming apart. And so that will be one key lever. The conversation had at the press conference will be the other. And here, the script seems very much to borrow, most likely, from what Christine Lagarde said at the ECB, because clearly that seemed to work. The markets digested that message and found it to strike the right balance. That's what we're going to look for here from the Fed chair. And importantly, just to anchor ourselves in what's actually occurring and why the Fed needs to continue to move forward here and why this is such a difficult thing to reconcile, let's remember what it is that the Fed is up against. So in the blue here, you see total global trade volume. In other words, global demand, global economic activity, taken in the broadest possible sense, the sum total of everybody's exports and imports, because of course, one country's exports are another's imports to some extent, and in a very simplistic way. So this is overall global economic activity in a very kind of broad sense. And then, of course, we have our measures of inflation. And so we can see that from the beginnings of 2020, so right around the end of the first quarter there, you have the bottom, the COVID-induced bottom in both inflation and in overall economic activity. From there, you have the gradual recovery. Not surprisingly, it is that March that you get the Fed announcing open-ended QE and basically stabilizing things to some extent. And then, of course, other central banks follow with their versions of policy stimulus. There's a big splash of fiscal stimulus, and not surprisingly, in the subsequent months, growth rebounds and inflation goes with it. Then, from the beginning of 2022, as the Fed gets going on rate hikes, you can see they've successfully arrested the pace of global acceleration without crashing anything so far. So the growth story actually looks fairly well supported, but inflation is coming in because the ramp up has been essentially stopped in its tracks. And the peaks there, of course, lining right up with the Fed starting to hike rates in March of last year. So this is the effect that the Fed has had so far, and what it has achieved is inflation of about 5-6%. The question then is, well, how do you then get to 2? And this is where the part about long-term rate hikes comes in, and rates that are generally higher. As you can see, there continues to be a very significant mismatch in U.S. labor supply versus demand. And we talk about, of course, the U.S. here because it's the Fed that we're looking at. And so their considerations are, not surprisingly, U.S.-centric. The implications of their actions are, of course, global because what they're doing is moving the borrowing costs for dollars, which is the global currency of commercial transaction, overwhelmingly. And so when the Fed increases the cost of borrowing those dollars, it's influencing the cost of borrowing the world over. But what goes into those decisions, of course, has to be contingent on domestic conditions in the U.S. And so what you see then there is a labor market where the number of people employed and plus job openings available is exceeding by a big margin the actual labor supply, the U.S. labor force, those people that are either in work or looking. And the upshot of that, if you take the difference between those two, you actually take the supply-demand balance, you can see that we are now in deficit. We were at peak labor surplus at the point where inflation bottomed. As we started to get that surplus labor situation worked down, inflation rose. Not surprising, of course. And now as we are in a labor deficit, the bidding up of wages is getting inflation higher. So we were able, with rate hikes, as you can see, to cool that and shave the goods part of this, the part of this that can be achieved by cooling economic activity to some extent. But it is this labor market component that's likely to keep things elevated and keep rates higher. And this is the messaging then that the Fed has to ultimately get the markets acclimated to. That even if things go slower, that even if the Fed has to proceed more cautiously and address bank failures along the way, this is the long-term fight. And without a structurally higher rate profile across the curve than what preceded all of this recent crisis and certainly preceded COVID, we are not going to get a handle on inflation to the Fed's satisfaction. And so the bias to continue fighting it remains, and probably remains in a longer term way than the market's aggressive rate hike expectations are anticipating. And that is Macro Money for today. Thank you very much for joining me. We are here Monday through Thursday every week, just after overtime with friend of the show, Chris Vecchio, head of futures at Forex here at Tasty Live. I'm on with him on Fridays for Futures Power Hour. I am then on Sundays with Tom and Tony for First Call. Outside of those, you can catch my various musings on the market via Twitter at Ilya Spivak. Thanks very much for joining, everyone. We'll see you here tomorrow. Take care.